There's two parts to achieving great credit. First is your credit score, and second is the type of accounts you have. Let's start with score. As a general rule, scores between 740 and 850 are considered to be great credit. This is where the best interest rates and incentives are found. Good credit is 680 to 739, and this range is usually good enough to get an approval at a great interest rate for most types of credit. Fair credit is 600 to 679. Now, this is where you're going to start seeing higher interest rates as lenders build in fees to offset their high risk. Credit scores at 599 and below are considered to be poor. Now, this is the score range we want to avoid altogether or get out of as quickly as we possibly can. Now, let's talk about the type of accounts, also called your credit mix. And even though your credit mix is only 10% of your overall score, lenders like to see that you have experience with different kinds of credit. A perfect credit mix would include at least one of each of the following accounts. First, a revolving account. That's a credit card. Credit cards are unsecured, meaning there's no collateral like a car or a home that's securing that extension of credit. You can charge up and pay down a credit card. Second is an installment loan. This loan is paid over a specific period of time, like 48 to 60 months. Think of a car loan. And third, a mortgage. Now, a home mortgage is an installment loan, but it's different because qualifying for a home loan requires a degree of financial and employment stability that lenders love to see. Having said that, you don't need to own a home to reach the excellent score category of 740 and above. You can get there using the strategies that I'm going to teach you in this course. Also, you don't need all of these accounts to be currently open. They only need to be present on your credit report. For example, if you have a car loan that you paid off, say, 5 years ago, you'll get credit for that installment loan even though it's paid and closed. A good credit score is the result of stability and consistent payment history. For those working on improving their credit, this is going to become even more important during your credit repair process.